Hey everyone, Coach Investor back to another video for today. So let's talk about Nike. Stock was down 13% on Friday. So what exactly happened? Because if you've seen the headline numbers, you know that it beat on revenue and on earnings per share. So what exactly went wrong and why did it basically bring the whole market down? Well, maybe not specifically the whole market because of Nike, but well, the sentiment certainly changed. So we're going to have a look at that in this video. We also have a lot of new analyst price targets and ratings, so we're going to go over that as well, and the key points from the earnings report. So the first one I want to touch on is Bank of America. It reiterated a neutral rating, with the firm saying it sees a balanced risk-reward as the near-term promotional actions and macro uncertainty weigh down fiscal 23 earnings per share, but should create a healthier business over the medium term and a stronger growth algorithm in fiscal year 24. Then we have another note from Morgan Stanley, said discounted valuation on Nike feels fair for now, but also makes for a potentially attractive entry point for long-term investors. The firm kept an overweight rating, but noted that it preferred other stocks in the sector. The price target on Nike was dropped to $120 due to the lowered near-term expectations. Then we had one from BMO Capital Markets, came in with a price target cut on Nike from $128 to $110. Jefferies dropped its price target from $130 to $115. Cohen from $127 to $114, and Deutsche Bank clipped its $123 price target to $99, and there are many more lowering as well. Now, it's very important to note that although they lowered their price target, most of them are still bullish on the company, and as you've seen, the price target is still quite higher than the current price today, which is $83. Now, as you can see, it says here it beat earnings per share by 1 cent and it beat revenue by 404.27 million. So not that bad. But then again, that wasn't the whole story. The overall rating you get here on Seeking Alpha, by the way, do check the link down in the description below if you want 50% off your subscription. You can get unlimited access to all the articles on the website and so much more. So valuation right now is still an F, growth a D, which makes sense. Profitability is still A+, momentum C+, and earnings revisions a C. 3 months ago and 6 months ago, obviously it was a bit better. Now for valuation, it still is an F regardless. And why is that? Well, because Nike trades at a premium compared to its sector. On every metric you want to see here, it is a very high premium. But then again, if you look at Nike as a business, it is, well, a premium company, right? The brand is recognized worldwide. But then again, the question is, do you want to pay such a high premium, especially in the current market environment? Now, overall, for the future, the analysts are still expecting some earnings per share growth year over year. As you can see here, I'm just going to look until 2025 because you still have 13 analysts there. Then it drops to 2 and 1, so it doesn't really make sense. So you can still see here quite nice growth there. Then forward PE, it does come down significantly. But when it comes to revenue growth, you don't really have double-digit growth. You have, well, high single digits, which again, if you look at forward price to sales ratios, it's acceptable. And for those that like dividends, well, Nike does pay a nice little dividend, 1.47% dividend yield, which equates to $1.22 annual payout. So now that we've got that out of the way, what exactly pushed the stock down so much and all the other companies in that industry as well? And that's obviously inventory, plus, of course, the currency hit, which we know about and which every other multinational company will report a big hit on that front in the coming quarter. So first up, we also have a gross margin decreasing 220 basis points to 44.3%. So not great there, but the big red flag here was this. Inventories for Nike were $9.7 billion, up 44% compared to the prior year period, driven by elevated in-transit inventories from ongoing supply chain volatility, partially offset by strong consumer demand during the quarter. This is a big number and this is a big red flag for now. 44% up on inventory, And it makes sense, right? Because everyone probably ordered a lot during the pandemic, were afraid that they wouldn't have enough stock, and so they ordered a lot. And currently they probably have too much in their own inventory, so, well, they're not asking Nike for more, which is a very good sign for the consumer, which means you could probably get some nice little discounts coming up, especially now that we're entering the quarter of the holiday season. Now, a quick note on the Chinese market, that's down 16% year over year, and I think it was much better than what most feared. I believe I had one analyst that said he believed it would be down 20%. It's only down 16%, not great, but better than what was feared. Now, with regards to the currency hit, we had some more information during the earnings call. So they say here that for the second quarter specifically, they expect reported revenue to grow low double digits on strong consumer demand, despite 900 basis points of foreign exchange headwinds. 900 basis points of foreign exchange headwinds. That's a very, very big hit. Now, of course, it is a headwind today, might turn into a tailwind later on. It really depends on the situation of the US dollar, but 900 basis point hit here is, well, something to look at. And last thing here with regards to inventory. So Robert something here, I'm not going to butcher the last name, asked this question. The first one is, when you look at the inventory situation, and I guess specifically North America, when do you think you will have recalibrated the supply demand for Nike? And I guess just wondering if what you think about the industry, when you think the industry might also sort of be better in balance on the supply demand equation. To that, he got an answer like this. So as they mentioned during the call, the inventory grew 44% this quarter, which was led by 65% growth in North America. And maybe just as a point of context, because you're right, it is North America where we're focused, where we saw the most significant, where we've seen the most significant volatility and disruption in the supply chain. In Greater China, as an example, our inventory was down 3% versus the prior year, and we feel quite confident about our inventory levels in Europe, Middle East, Asia, and I believe this is probably Asia Pacific, Latin America. They continue by saying that in North America in particular, they saw in-transit growth of 85%, and in-transit inventory now represents approximately 65%, so almost 2/3 of North America's total inventory. And that's really being driven by a couple of factors. The first one is the disruption that started over a year ago when their factory closed for almost 15 weeks in Vietnam, and for a lesser extent in Indonesia. And the decisions that were taken after that with regards to inventory that was in process to be made. I'll end with this paragraph right here. So when we look at the overall inventory, we think that there is about 10% of the inventory that we're focused on in terms of trying to drive more accelerated liquidation. And while our inventory was high at the end of the first quarter, we do expect to see sequential improvement in inventory balances from here over the next 3 quarters. And you'll see this with a lot of retailers. Obviously, we've seen that with Walmart and Target. In the last quarter, they warned us about this. Expect this to happen to every other retailer this quarter as well. Inventories are high. They will be trying to liquidate it in the coming quarters. Holiday season is coming up, so you might see a lot of sales happening because, well, everybody wants to liquidate as soon as possible. We've seen that also with the likes of Nvidia, by the way, right? So this is a story that you will see and continue to hear about during the next earnings report. Inventories are high, currency hit, you name it. But overall with Nike, it's obviously a great brand. It's known worldwide. They obviously have the brand equity. The price of the stock has come down. Yes, traditionally, if you look at the PE ratio, it's still considerably high, especially if you look at the growth ratios, but it's also paying a nice little dividend. So they have that on that front. They are repurchasing some shares as well. Overall, if it becomes a bit cheaper, I do think it will become much more attractive. If you hold some shares, obviously do let me know down in the comments below. Check out the Seeking Alpha link down in the description to get 50% off your subscription as well. And that will be it for this video. If you like it, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And I'll see you all in the next one. Bye bye.